This week, Bill Ackman made headlines as he revealed that his hedge fund, Pershing Square Capital, initiated a position in Uber. And in fact, Ackman made Uber one of the largest positions in his entire stock portfolio. Later during the week, he also shared a presentation in which he outlined the investment thesis behind the Uber purchase. So in this video, we're going to break down the different pillars of his thesis. And so without further ado, let's get started. Alright, not too long ago, on the 7th of February, Bill Ackman revealed on X that his hedge fund, Pershing Square Capital, started a position in the ride-hailing company Uber. You can see the tweet that he put out on screen right now, and let me just read it to you. He wrote, beginning in early January, so after Q4 has closed, that's why the most recent 13F filed by Bill Ackman does not include that position yet. So beginning in early January, we began acquiring a position in Uber. Today we own 30.3 million shares. Let me just show you one tweet that I put out basically the same day, I think, that highlighted what a big bet this really is. So if we look at the 30 million shares owned by Ackman, multiply it by the current share price, or the share price back then was $76 a share. I think as of today it's $79, but back then based on a $76 per share price, the stake represents more than $2 billion US dollars, $2.3 billion US dollars more specifically. And I think few people realize how big that bet actually is. If you take a look at the overall portfolio here in the screenshot, and actually I included a screenshot of the most recent portfolio because by now the Q4 13F was revealed as well. And as you can see here, 2.3 billion position is going to be one of the highest weighted positions in his entire portfolio. You have to be aware that the Google position appears twice because Ackman owns both share classes. So Google represents around 15%. And then you also have to be aware that Ackman owns shares in Universal Music Group, which is not listed in the US and hence doesn't appear in 13Fs. But I think that's also quite a material position in his overall portfolio. But regardless of the exact math here, the Uber purchase represents one of the biggest bets Ackman has placed more recently. And that's, of course, big news. Going back to his initial tweet. So then he wrote, I have been a long customer and an admirer of Uber, beginning when Edward Norton showed me the app in its early days. I was also fortunate to be a day one investor in the company through a small investment in a venture fund. What a great business, Uber suffered from erratic management. Since he joined the company in 2017, Dara Khosrowshahi, CEO, has done a superb job in transforming the company into a highly profitable and cash generative growth machine. Keep in mind that being highly cash generative, that's one of the key pillars of a business that Bill Ackman is looking for. We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. We'll have more to share about our thinking on the company shortly, and that's what I said I will get to in a moment. So what I'm going to show you here is just a response by the Uber CEO himself. He thanked Bill for the trust he puts in the company, and he's looking forward to continued engagement with Bill to find areas in which Uber can do better, improve as a business, and so on and so forth. Okay, before we move on and actually take a look at the presentation that Bill shared a little later, here's the share price performance of Uber. And as you can see, the stock has done all right. It returned 94% over this 5-year time period, which reflects almost 15% CAGR. So when I said it did all right, that's an understatement. A 15% compounded return is, of course, fantastic. Year to date, the stock is also up 33%. You can see the spike in the chart in the top right corner already. So I feel like the sentiment towards Uber, which was, well, I would argue a little more bearish more recently, has shifted again. Okay, if we now actually take a look at the thesis of Bill Ackman and the various elements of his investment thesis, we are going to take a look at the presentation that he shared on February 11th. There were 4 slides in total focused on Uber specifically. So I'm going to break down some parts of his investment thesis. So first of all, he highlighted, and I want to be clear here, not too long ago, I published a video on Uber myself in which I discussed the various advantages of Uber's business model that I see in Uber in more detail. So I'm not going to cover that here. I'm going to pretty much primarily or exclusively focus on what Ackman had to share in this presentation. So he, just like I do, sees strong network effects that are super hard to replicate by any up-and-coming competitor. Just because reaching the scale that Uber has reached is incredibly hard. So he points to the monthly active customers, the A bar chart that you can see towards the bottom of this slide here is actually taken from the most recent earnings result from Uber, and it highlights that the monthly active customers are really growing at a high clip, low to mid-teens rate, and has reached 171 as of the most recent quarter. Then if we move on, then he highlighted, and that's something he highlighted in the initial tweet already, that he has a lot of trust in the CEO of Uber, Dara Khosrowshahi. I'm not sure if I mispronounce his name here. As he highlights here again, and that's what he said in the tweet, that he believes he did a great job making Uber actually profitable, making it to quote him here again, highly cash generative company. And he praises his cost discipline here, which is something that I have also highlighted in my initial video, in which I included this quote here from the CEO himself. I think this was taken from an earnings call not too long ago, and he said, a low take rate creates a meaningful barrier to entry. Second, a low take rate helps create internal pressure on the organization to constantly drive out costs and ensure that we are running the network as efficiently as possible. You see that in every quarter report sort of a few basis points of incremental margin that we are able to extract from our cost structure by continuing to grind down those costs. Again, that reflects Uber's sort of that operational part of the organization. And again, I think Ackman is right. The management team and the CEO specifically seems to be super cost conscious, which is something as an investor you like to see, because this will ultimately drive margins higher and make the business almost as profitable as possible. In the comments of the initial tweet that Ackman put out, in which he revealed that Pershing Square is now an Uber shareholder, the CEO actually engaged in a little conversation with Ackman here. So, for example, he asked him about suggestions, how to improve the Uber business. Bill made a couple of points here, highlighted that he sometimes wants to book multiple rides at once for family members, for example, which is not possible. He was also pointing to the tipping system of the Uber app. And I feel like the CEO was quite responsive here, was eager to learn more about how the Uber customer experience can be improved. And again, those would be sort of green flags that I would like to see in a CEO. Moving on in the presentation. And right here, he actually highlights three parts. So Ackman. The first one is that he expects the business to grow its earnings on a per share basis at a rate of 30%, at least over the next several years, so over the midterm. And this is reflected in the screenshot you can see on the top. You can basically see the analysts' estimates for earnings per share growth over the next 2 years. That was calculated by Ticker, and I think what they do is they take a look at a bunch of different analyst estimates and they take the average or maybe the mean of it. So here you can see that these analysts are also guiding for 31% growth next year and 22% growth in 2027. So Ackman may be onto something here. I think that's probably a reasonable forecast to believe in. Then the second pillar of what he wrote here is that he believes there will be margin expansion. And that, of course, is related to the first point. I think the margin expansion itself will contribute to the say 20 to 30% earnings per share growth that Uber could potentially reach over the coming years. In the background, you see the EBIT margin profile and how it developed over time. So as you can see, for the most part of its public history, Uber was actually unprofitable. So up to say late 2021, the business was losing money on an EBIT basis, and ever since it has become more and more profitable. As of the most recent quarter, and I think those are last 12-month numbers, yes, the EBIT margin stands at around 6 to 7%. 6.36. And obviously what you have to ask yourself is, where is the ceiling? How much more profitable can Uber actually get? And I'll get to that. I'll discuss that in a little more detail in a moment. And then the last part that I want to highlight here, and that Ackman highlighted in his presentation, that he thinks share repurchases will also contribute to the return that investors are going to experience. If we go back to the earnings per share growth forecast, the 30% may be partly attributable to the share count of the overall company being reduced. As you can see, over the last 3 years at least, the share count has actually been trending upward. So I guess you would want to bet that there's going to be a reversal, that you can observe a reversal at some point. I'm not sure how likely that is. That would be something where not necessarily with Ackman. I mean, he's not specifically talking about share count reduction, but I know that that is something he likes to see in companies too. The problem with Uber is that the company is paying its employees in stock-based compensation quite a lot. So you also see the stock-based compensation here over time, which is trending upward. And I've talked about this in my initial video, that the free cash flow generated by the business, adjusted for stock-based compensation, is actually not that material, or at least not as high as the EBIT margins would, for example, reflect. All right, moving on in Ackman's presentation. He then wrote, currently Uber is trading at 29 times earnings due to concerns regarding the potential long-term threat from autonomous vehicles. And I highlighted a more recent PE chart and basically valuation multiples, various valuation multiples chart here as well, after the more recent quarter in which Uber once again posted pretty good results, I think. Due to an increase in earnings, the multiple has actually come down further. So on a last 12-month basis, Uber is now trading at a multiple of around 17.4 times, 24.2 times on next 12-month basis, and 24 times free cash flow on a last 12-month basis, again, not adjusted for stock-based compensation. You may wonder, well, why is the next 12-month price to earnings multiple higher than the last 12-month price to earnings ratio? Well, that is something that I highlighted in this tweet here. The current earnings of Uber are actually a little overstated due to various accounting things going on here. Most specifically, Uber is benefiting from tax benefits that basically have increased the earnings of Uber as a whole, but those earnings aren't actual profits. So that is something to be aware of. And obviously, this is a one-time effect. All right, moving on to another slide from Ackman's presentation. So here you can basically see that he's also believing that Uber is going to benefit from operating leverage effects. He wrote, there is a large degree of fixed costs, which allow for significant operating leverage, e.g. 3% annual headcount growth versus 20% annual bookings CAGR since 2019. And I think he may be onto something, but I looked at Uber at a much lower price, low 60s, I think. And what was holding me back a little bit was, first of all, the valuation, but also that I had problems regarding the development of conviction in Uber actually enjoying significant, massive operating leverage effects. So I think the problem is that Uber actually has a lot of fixed costs in contrast to what Ackman is saying here. I mean, if you take a look at a Uber ride, let's say it's a $20 ride, usually the take rate of Uber is around 20 to 25%. So let's just say $5 per ride, per $20 ride. Obviously, so as you can already tell, the fee that the driver is getting is also going to reflect a huge part of the customer's cost already. And then on top of that, from the $5, for example, you would also have to deduct insurance costs, which are significant for Uber, but also some operational expenses. But then again, there may be some more fixed costs, such as research and development, and also sales and marketing. I get that. So there's probably some operating leverage effect left. How much, however, I don't know. I think in my initial video, I said that I could see Uber getting a 20% margin business, but I don't think it's going to be materially higher. But again, that's a lot of upside still from the current profit margin level, but we'll have to wait and see, I guess. And that's what Ackman actually also highlights here. So he's not necessarily betting on Uber reaching, say, 30% EBIT margins. No, he's basically referring to the company's articulated long-term margin goal of 7% EBITDA margin. All right, there are two more slides that Ackman shared. This one shows the development of the share price over time and also the development of earnings per share. He just highlights that that's what you can see at the bottom of the slide, that he believes Uber's price to earnings multiple is low considering the potential growth trajectory of earnings that the business is going to follow. And I think he's right. So if Uber can continue to grow at a rate of 30% over the midterm, well, then a mid-20s multiple, for example, maybe a high 20s multiple, maybe understating the actual value of the business. Maybe before we move on, full disclaimer, and I think I said this before, personally, I don't own any Uber shares, and obviously this is not investment advice. I'm not interested in Uber right now at the current price. I wasn't interested in the low 60s. I think Uber, the business, will probably do well over the long term. What the stock will do, I'm not so sure. I wouldn't want to bet against Uber, that's for sure. Okay, the last slide from Ackman. So first of all, here's also highlighting the per ride take rate, which he assumes is around 20%. And then he highlights, let me add one more thought here. So he writes, Uber's 20% per ride take rate is low relative to the value it provides, which maximizes vehicle utilization and driver revenues. I'm not sure if he's 100% spot on here. And that is something I've actually discussed in my investing community. And one community member, Rookie, he particularly has stressed various times that he believes Uber, from his experience, Uber rides have become significantly more expensive. And that's what's also reflected in this Reddit post here, for example. Uber is getting more expensive. I take Uber a lot. I have the monthly membership. I take this same route all the time, and historically it's been around $30 per ride. Today it was over $80. So I'm not sure if there is much room left in terms of pricing power of Uber, my understanding is, and I'm not an Uber customer myself, I very rarely use an Uber. So let me know what you think. But my understanding is that Uber rides have become significantly more expensive and nowadays aren't necessarily cheaper than a typical taxi ride. So again, I'm not sure if the price of an Uber is cheap relative to the value it provides today, which would certainly cap the pricing power of Uber in terms of, well, the price per ride that they are able to charge, which would or will of course impact their profitability as well. And then he also writes, attempting to replicate Uber's capabilities is just really hard and doesn't make much sense from an economic point of view, and I think he's right about this. I also wanted to highlight this article here from The Guardian, in which basically they highlight how in the UK specifically, being an Uber rider is pretty hard. It's no longer as lucrative from a business point of view as it used to be in the past. Just to quote from the article, here they are quoting one Uber rider who said, well, it has reached a point where I can't do it anymore. And he's considering leaving the job. And later he said, for some rides, that rate can be less than £1 a mile, including a holiday pay, whereas previously it was often £3 a mile. So that's one of the concerns you maybe should have as an Uber investor, considering the different stakeholders in the Uber ecosystem, that it seems like riders aren't treated fairly. And I'm not sure if that is going to be a problem for the business long term, because I'm not sure how sustainable that is going to be, that relationship between Uber and its riders. Are they going to look for alternatives? Are they going to alternative ride-hailing platforms? Are they going to look for alternative jobs, which might lead to problems? I guess that is something we will have to wait and see. Actually, Ackman, not too long ago, he was posting this very critical tweet of Uber on X. So on the very same platform on which he now revealed that he is a shareholder in Uber. And he highlighted that Uber is, I'm quoting here, massively increasing its margins and profits in New York City by ripping off its New York City cab drivers. So sort of a similar point that was made in the Guardian article. And then finally, just to get back to the last slide in which Ackman talks about some of the risks associated with an investment in Uber, he highlights the AV threat, so the risk of maybe our mobility, or the way we move from A to B, shifting to autonomous vehicles. That is something I have also discussed in my initial video on Uber, so I recommend checking this video out next. But he highlights that he thinks that transition is still many years away. So he wrote, a large-scale US AV rideshare introduction is unlikely for many years. However, what I will say at, say, 27 times earnings, well, how many years do you really need that shift to be away? Because assuming that Uber wouldn't be growing at all, well, it would take you 29, 27, depending on the multiple that you arrive at. Let's say Uber trades at a multiple of 27 times earnings. It would take you 27 times just for you to make your money back. That's your payback period, so to speak. So obviously I'm simplifying things because Uber is growing, but I don't know if we're going to have that transition in some areas, at least in the next 5 years, for example. Well, I'm not sure if that is reflected in Uber's valuation, and that is something you will have to have a strong and hopefully right opinion on. Like, I could definitely see a scenario in which AVs will be booked via Uber's platform, or at least partly. So that could be a way to counter that risk, but that is something you have to think about as a potential Uber shareholder. All right, and that's already it for today's video. Let me know what you think of Ackman's Uber purchase. Did it surprise you? Do you think he's right with his bet here? And I'll talk to you in one of my next videos soon. Take care.